Hi, Steve Van Metre here. Welcome to your Monday Night Premiere, where we take about 15 minutes every Monday and Wednesday evening to try to make sense of a market that might actually be making sense now? No. Well, maybe. But before we get to what is driving today's big drop, let's get the disclosure out of the way. The content of this video is provided as educational information only. It is not intended to provide investment or other advice. This appeals not to be construed as recognition or solicitation by a seller, security, financial planning instrument, or participate in any particular trading strategy. This video was prepared by Steven Van Metre on personal capacity. Opinions expressed in this video that do not reflect the view of Atlas Financial Advisors Inc. or Steven Van Metre Financial. So, it just seems like over the last, almost 2 years, trade wars are bullish. Buy stocks because we're having a trade war. Buy. And when you're not sure, buy some more. But today, trade wars aren't so bullish because the trade war is now morphing into a currency war. So what happened is China decided to respond to President Trump's threat. Mind you, at this point, it is a threat. There is no official additional tariffs being added on September 1st. But at the moment, there is somewhere between 300 to 350 billion of imported Chinese goods that could be subject to a 10% tariff should President Trump decide to put that in place on September 1st. The reason this is a bigger deal is these are going to be all consumer goods. So these are things that, and look, I get that when you go to the store, prices are up. Now you're going to notice it if these tariffs are passed because these are going to be things that you and I spend money on every day. We're going to see it. Consumer goods, things like cell phones and electronics, and who knows what other stuff we import to China, but lots of it. It's all going to go up in price. Now, China said they were going to respond. They were not going to be bullied or threatened. And so what they did is and I don't want to imply that they directly devalued their currency because I don't know that for a fact, but their currency was devalued, whether it was them deliberately doing it, or as they claim, well, we're just letting it float on the market a little bit more, letting the market decide. You decide which way it is. But nevertheless, the Chinese yuan fell in value against the dollar. So China's saying, look, you go ahead and tariff all you want. You want to raise, you want 10% tariffs? We'll just devalue our currency to offset it. We can do this all day long. And that way we can keep our prices at the level that we're at now. Of course, obviously, President Trump was not happy about that, and neither were markets. I mean, markets just do not like currency wars because there's one thing to have a trade war where you're disagreeing and trying to work things out, but when that doesn't work, you go to the currency war, and when that doesn't work out, you go to a shooting war. That's what they call hot war. That's where this heads. And the markets, frankly, don't like currency wars because as China devalues their currency, what happens to the dollar? Well, it should rise. Now, it didn't rise today, but that should be the normal direction of what the dollar does. And what does a rising dollar do to corporate earnings and profits? Straight down. And even though everyone's been excited about earnings, which are virtually no higher than they were, at least in case of Apple, than they were 5 years ago, and profits are actually declining, rising dollar is bad news. And if China allows their currency to further devalue, it gets really bad here really quick. All right, so let's go and take a look at some of the things that were driving the market. And it was the quantum computers that were doing quite a bit of the selling. We'll look into the markets shortly here, but let's go down here. This article is posted on Zero Hedge this morning. But here we see the CTA models, S&P. Now, this is from Nomura. Now, there are lots of different computer models with different sell levels or buy levels, but this is the one that we get every once in a while when the guy that works there, Charlie McElliott, decides to share it. He does publish it on his daily letter, but you cannot get one unless you're a client, and you got to have a lot of money to be a client of their firm, a substantial amount of money. And if whatever you think of substantial, add some zeros to it. So the CTA models position below 2946. sees a sell signal cut from 100% long to 66%, triggering deleverage. The next sell signal at 28.30, which we did not close at. These are closing levels where it was flipped to a short level at a minus 59% position. So these models went from buying to selling today. They reduced their long exposure, and they're very, very close to actually a short of the market and a max short under 27.14. Now, if you were to note these levels, they do change daily, or they can change daily. So the life expectancy on these is not long. The NASDAQ positioned already reduced to see a sell signal decline from 100% long to 66% long, and the next sell level is at 73.75. The Russell 2000 is already almost at minus 60% short, with more selling under 15.15 to get to max short. I don't know if we got, I should have looked to get there. So this is what kind of was driving the markets today, is selling due to problems what are called the shift in short gamma. This stuff is very technical, but what matters is who was driving the selling today. It was the computer model. Now let's look at how the hedge funds are positioned going into this, because this is very interesting. What did we see today? We saw 10-year Treasury yields get very, very close to their all-time lows. Or very close compared to they were months ago. We'll look at that. And how are the hedge funds positioned? Short. So here yields are falling and they're betting on yields are rising. And this is fantastic. If you own Treasury bonds, as pretty much all my clients do, then this is going to make you happy, because if people are short and interest rates are falling, that means at some point they're going to get squeezed out of their short positions and buy. And what happens when they're falling and these hedge funds start buying, there is a plunge in yield and a surge in bond prices. And so you can see the bottom is not in until these people are long. How about 30-year yields? They're short as of last week as well. And yields are not far from their all-time lows. They actually fell quite a bit today. And again, these hedge funds are short, meaning that we're not going to see the bottom until they're long. So again, good thing to own U.S. Treasuries when you know that the market is misbalanced and that the hot money is on the wrong side. Crude oil fell slightly today. We can see that hedge funds are massively long this, and that's a big mistake, because as I showed you in Friday's update, when the Fed starts to cut, oil goes down, it follows yields, and yields are falling. So that means oil should fall, and we should start to see, we've been seeing crude oil draws. We should start seeing more crude oil builds because due to financial conditions tightening. So will we see that this week? Don't know, but what we should see in the weeks that come is inventories building. So looking at the S&P, we see the hedge funds are long. And obviously that didn't work out for them today. And as far as gold, they're long, but gold is really running out of steam here. We'll look at, again, at emerging markets, which does generally give a direction for gold, is headed down. Gold does go down when both yield and inflation, consumer prices are falling. There's no doubt consumer prices are headed lower at this point. We've already seen them start to fall. NASDAQ, hedge funds are long. They got drummed on that today. And the only place that the hedge funds were in the right position so far was Russell 2000. They were very short small caps, and small caps fell today. We'll look and see how far they fell. But you can see the computer models were 60% short, and there's a lot of other selling that can happen from here. They were long. The dollar was down a little bit today. This is probably the right direction. I do believe the dollar is going to go a little bit higher, but currencies are one of those things where you can make a lot of money, and then as soon as you make it, you can lose it even faster than you made it. And another place the hedge funds are getting hammered is in volatility space. They're heavily short volatility, and you can generally see that markets don't bottom or volatility doesn't peak until these positions are unwound, and be very curious to see how all of these positions are going into next week. Be very, very curious on that. All right, so let's switch over to the charts, get those windows out of my way so I don't have to look at them, and let's take a look at the broad equity indices to start out. The S&P 500, you can see nice waterfall drop here. Now, you know what? Why did it do that? I forgot to show you the NASI. let's go and take a look at the NASDAQ McClellan Summation Index, which I said at some point when this thing gets under zero, it predicts a plunge in price. And we saw that rally, the price rally in stocks to new all-time highs. We did not see the NASI go to new all-time highs. In fact, it just barely got over zero, rolled over, and as of close of business Friday, it was back negative. And this is telling us this market's got a long ways it can go down. Liquidity is tight. So it shouldn't be a surprise that there is selling going on here. So S&P 500 closed below its January 2018 lows. The NASDAQ, it closed just under this mess here. Roughly it's July 18 area range, and the Dow closed. Remember that triple top? I thought, well, this has got to be the top. 1, 2, 3. How much more do you need? And we got one last move up. Boom. It came down, tagged its 200-day moving average, and bounced a little bit under quite a bit of selling. But the volume will be interesting. So look at Russell 2000. It got under 1515. And so that means we are going to get max short on the quant models tomorrow. So they base their decisions on the market close. And the S&P 500 needed to close under 2830 to flip short, and it did not. It briefly got under 2830, found some last minute buying, got up there, but this thing's very close, just flipping into a short position. From a volume perspective, is this the bottom? No, not really. You can look at the volume coming back here to this bottom and see it was way up here. This volume is showing the early stages of selling, certainly not the late stages where everyone's going to dump. So there's no panic in the markets yet. We do expect elevated volume, but this is not a strong sell-off bottom here at all. So very likely we should continue to see further selling. Let's take a look at Treasury yields. 10-year Treasury yields. Remember, everyone said these things were, well, I'll tell you what, the CEO of JP Morgan, Jamie Dimon, said they're going to over 4%. Right now, they're, I don't know if this never gives me the exact right closing price. But anyways, you can see close around 1.7% with the low being 1.3. So we're 0.4% difference. No, I'm sorry. We're more than 0.4% away. Not far. We're very close. Remember, up here, people are panicking, dumping bonds. This is bad news. And look, I said this was a huge topping pattern. Do you believe? It is. There it is. Looking at 30-year yields, this is even uglier. They're almost back to their all-time lows at 2.1. And this is what's really cool about all of this is those hedge funds are short. That means they've still got to go and buy long to get out of their short positions, and we haven't seen any other computer model selling, and they're going to. And I'll tell you why, because when you look at volatility is spiking, and there's trillions of dollars in volatility control products. As volatility rises, they will sell from their equity positions to buy bonds. If this can keep going, that dynamic will continue, and we should see new all-time lows potentially in U.S. Treasury yields. And we haven't even talked about what could ever happen if this does get down here and breaks its low. There should be a flood of buying, because guess what people do? They like to buy things at their all-time high, or in this case would be all-time low. So we haven't even seen a flood of money flowing in here. If we go and look at the ETF, the TLT, which we are in, we're not seeing crazy volume. We're seeing elevated volume. Buyers are coming in, but we're not seeing gangbusters blow out, take this thing to the moon volume. We also picked up last week some on, was it Friday or Thursday or Friday? SHY, short-term treasury yields as cash replacement. This is moving up. Very happy about that as well. And let's take a look at ag commodities. This is kind of the surprise story of the day. When you get all the bad news you can get, which this sector has pretty much been bad news, and you get the biggest piece of bad news you could get, which is China, and I don't have confirmation of this, but it could be true, that they are not buying any more U.S. agricultural commodities as of right now. Now, if that is true, and it probably is, then you would expect this thing to go to the floor. But when you get every last bit of bad news that you can get and prices rise, it tells you there's a bottom. So look at this today. Came down. We formed a double bottom to the May lows and a surge up in price. Closed slightly in the green, but nevertheless, that tells you quite a bit. It tells you now all the bad news price is priced in. And on the 12th of August, what's going to change is the USDA, who has been using its satellites to look down and determine the progress of crops. So if it sees that, let's say I have a farm, but only half of it's planted, they're not worried about the half that's not planted. They're focused on the part that is planted and trying to determine its condition. Well, on August 12th, they're going to, or supposedly going to determine acreage. And according to farmers, as I've told you, it's not pretty. I mean, we should have one of the worst crops we've had in a long time in terms of production. So that will be interesting. Let's take a look at the dollar. I know we're going overtime, but I think today it's worth it. Dollar went down. I do expect this to turn around and head higher. You can see it's finding support off its 200-day moving average. It hit resistance here, found some sellers. I don't think this is done. I think the dollar is going to go up a little bit higher and squeeze everybody out. Let's take a look at emerging markets compared. Well, what happened with gold? Gold kind of rose up and found sellers. Now, let's look at emerging markets. This could create an even bigger opportunity because emerging markets tends to lead gold. So how do we know that? We've looked at this before, but it's worth looking at now. Let's put in GLD, the ETF for gold, and you can see they follow each other. Now, what happens when gold gets a little out of line ahead of EEM selling down? It sells down, and we can see this relationship somewhere along here. Here you can see EEM going down, gold trying to go higher. This is back in 2008, and it does eventually come back down. It doesn't continue to shoot higher. And here you just see little spaces where one leads the other. So the fact that there's this big of a divergence, it doesn't seem likely. You can see it, beautifully right there. It doesn't seem likely that this should continue. It should reverse direction and create a buying opportunity. However, from the emerging market space, which trades very similar to gold in general, there's a major support level here. Let's zoom out to the weekly chart. This has definitely got my attention because if it finds support here, this is a buy ahead of gold because it should bounce. If it breaks through here, it tells us something much, much worse is coming. So we'll be watching emerging markets. Emerging markets are also a proxy for liquidity. So when emerging markets fall, well, so does the broad market. Take a look at lumber. It too is predicting demise in terms of inflation expectations. Here's how you know inflation's falling. Take a look at lumber prices, and at the moment they look like they're headed back to their 2015, 2016 levels in the near future here. So I expect that to happen. And let's take a look at oil and gas producing stocks. Big opportunity in this in the future. Here it is, just above its 2-year low, and I go as far as saying I believe that is its all-time low. Yeah, back below. You're talking 20-year low here, where these stocks are going to fall through. Love it, absolutely love it, and we're not seeing huge volume. So let's look back here. See all the volume here, the big spikes of volume that was stopping this waterfall down period. We're seeing intermediate in some spikes, and then it's coming down. Spikes and coming down. What you want to see is this spike, and then come to a bottom. This is not done because, again, federal funds rate tells us this can go a lot lower. All right, so let's get this wrapped up here. What else? Is there anything else I want to look at? Well, silver miners. Again, I know gold miners are going to reverse, but look, silver miners are telling us, look, we can't get over through this resistance, can't get through it. We tried to get up today, found sellers. Again, silver is telling us what emerging markets already knows, is that this should come down, confirm its bottoms in here, and then go. So simply to put, markets are starting to get interesting because we're not in this automatic up every day. We're starting to get some volatility back. And when you get volatility, it starts to create opportunities because people sell. Or in this case, we have computer programs selling. We have volatility programs, which I suspect tonight will start to sell because they do a lot of their selling in overnight trading. So we'll be watching the futures market tonight, see what's going on. But something interesting is coming. And the great thing is, as long as treasury yields keep going down, and we're winning there. So some good things happening. and hopefully some big opportunities coming that we can take advantage of. So I'm Steve Van Metre. I'll look forward to talking to you Wednesday, and hopefully in this very light week of economic news, well, maybe opportunities will continue to bring things down, prices down, so we can buy low, try to sell high. Have a good evening.